Welcome to Subramani. So let's get to some basics. FIIs did sell in October, November also maybe they are selling a bit, and the markets are going up and down. Let's face it, in the month of October the BSE 500, I'm not talking of the Sensex, BSE 500 fell by about 7%. 7% is big. And when there is a 7% fall, there is some kind of panic among the new entrants, at least those who have come maybe in January 2024 may wonder what is happening, right? So, but somebody who has been there since even 22 knows that these kind of fluctuations will happen, and it's not too bad. But I'm not getting into that. I'm just looking at the FII selling and looking at it as an opportunity, or is it should you be panicking, or should you be opportunistic and be buying? I'm not getting into too much of details, but let's get the basics right. The price of a share depends on the earnings and the PE. So which means the EPS and the liquidity, the earnings and the liquidity drive a market. This is not changed in the history of the markets, right? Whether you're talking of 1924 or 1824 or maybe 3024, it won't matter. These are the basics, right? Price in the market is equal to EPS into PE. PE is largely a function of many things, including the mood of the market and the liquidity in the market. Liquidity is almost impossible to guess, but you know that if some money has gone out, like FII money has gone out, good chance that it will come back. I have not seen FIIs as some great market timing experts. They are not. They make money by the time spent in the market, and their yield expectations are poor, much less than what we would. If they think they can get 4% in their markets, they are happy with a 7% return. But we may be looking for 12%, or somebody maybe even be looking for 18% or 20%. So our expectations are different from theirs. So they make money by staying on for a long time. But recently they have removed money. But I'm very happy the kind of resilience that our market showed, largely because of mutual funds and the SIP that they are getting, right? So if they're getting good SIP inflows, which they're continuing to get as of now, I think they could counter the FII selling well. So the market did not fall as much as it did, because the BSE 500 is not a great indicator of what the FIIs are doing, because FIIs may not have sold much on the shares below the top 150, right? Their holding may be very small, and even if their holding is there, the selling may not have been high. How much is the selling? So I look for some data. Volatility arises from sharp changes in earnings or in the case of liquidity, right? So more money comes in, market will go up. More money gets pulled out of the market will come down. Earnings changes, markets will come down, right? If the earnings fall, market will come down. If the earning goes up, market will go up, right? As simple as that. Predicting liquidity is impossible. None of us know from where the money will come. We don't even know where it will go. For example, China looked attractive for doing some transactions, so a lot of money left for India, maybe to go to China. If tomorrow, if Japan increases interest rates, maybe some money could leave Indian markets and go to Japan and put into debt instruments. We don't know. So liquidity guessing on an international scale is not something which we should ever think of doing. So let us look at the numbers of what the FII sold. Foreign portfolio investors, this I'm getting from some newspaper, foreign portfolio investors sold over $13.6 billion. That is about 1 lakh crore. Which is one of the highest ever recorded in a single month, right? So it's a big sale, no doubt about that. But you look at it this way, relative to their holding, they sold a very small fraction. They sold about 1.5% of their total holdings. 1.5% is not much, right? And there could be a promoter selling 1.5% of his stake just to maybe buy a bigger house or invest in something else, right? So these kind of investment, it never bothers me when a promoter sells 1% or 1.5%. So similarly, an FII selling 1.5% should not bother as much. And we know one thing, FIIs go out and they come back. mostly they come back at higher prices. So it should not bother us at all about 1.5% sale, because a 1.5% sale is not a vote on your condition. They are not negative about India. They are not selling because they think, oh, there's nothing going to happen. If I were invested in Bangladesh, I would, the political uncertainty would have meant, let me just sell off, let me not just hold on to these shares, let me get out. So India does not have a negative vote like that, but yes, more attractive markets are there outside. Second, another important thing is most FIIs have made good money in India, and typical professional behavior is to say, let me take some profits. Not right, not wrong. I'm not commenting on whether they should. Typically, I wouldn't sell just because I'm getting bored, right? I don't have an opportunity outside. Maybe if I had opportunity outside, I would consider looking at Taiwan, China, Japan. Right now, I don't remove from India and reallocate abroad. I don't do it. I have some foreign holdings, but that's a very insignificant portion. I think less than 10% of my net worth would be there, so it does not really bother me. So I don't understand that behavior, but I can appreciate that behavior what FIIs have done, right? Luckily for us, like I said, DIIs have been able to absorb most of the sale which happened. It's been a big dramatic sale, but we have been able to, aggressive selling by FIIs have been able to match by our aggressive SIPs which are happening, right? So whatever the numbers you see, it may not be absolutely right, but our SIP numbers are definitely going up, right? The trend is to go up. And this is perhaps not the first time that we are seeing FIIs sell in India. In Indian conditions, yes, they sold in Jan 2008, global financial crisis, US credit rating downgrade, taper tantrum, Fed hike, demonetization, right? Those are all times. NBFC crisis, all these things happened, right? So real estate, poor quality real estate happened in the US, NBFC crisis happened in India, then there was a slowdown, then there was onset of COVID, all the reasons when FII sold and FIIs came back. So just imagine, onset of COVID would mean March 2020 they sold, and they came back in September 2020. Obviously they sold at bad prices and came back at much higher prices. So these things happen. So I have never looked at FII's ability to time the market, nor even the ability to sit out of the market for long. So they have come back in the same month where they have sold for some times, right? So, and secondly, we bunch all the FIIs the same. It's not true. Some are based in London, some are in New York, some are in Japan, some are in maybe Korea. So all these are, we conveniently club it. It is actually A selling worth 100, B buying worth 50, and you still see, oh, they have sold worth 50. Actually, they've sold worth 100, but somebody else has bought worth 50. So that combination, aggregated number which is available to us should not be a great indicator to say, oh, this is happening and that is not happening. I also think that correlation is a statistical measure, so you have to be careful about what you are looking. You have to look at the scatter diagrams, right? So what I like is the domestic inflow is continuing to be at a good scale. The continuing inflow into SIPs, the DIIs are able to counter most of the FII selling, or the selling could have been more severe and could have had a more severe impact on the prices. That didn't happen simply because of the fact that we could absorb it, right? So is it a good opportunity for you to buy? One more thing is the shares which the FIIs have sold, if they have fallen and they have corrected, it may be a good time to be buying. But if the shares which have fallen are actually outside the top 200, right? So don't look at BSE 500, look at BSE 30 or the Nifty 50. That is where most of their selling would have come. So there could be attractive numbers there. Then look at charts. Maybe you should aggressively bulk up on Nifty or Sensex rather than going and specifically buying some shares. But if you pick up some share which has really fallen, where you know the working is good, I think you should just go and treat it as an opportunity. But it also means that you have to be careful and you have to be able to understand that the FII will buy, will sell, all these things will happen. I mean, could just be China in and therefore India out. It could also reverse after some time and say, okay, China, the fun is over, now we'll be back to India. Both of these things can happen. And in an uncertain market, which means almost every time, and there is a risk off approach, you try to take some money off the table and put it back somewhere else. So Trump's coming, if you're bullish about US, you may pull some money out of India and put it even in the US, not just India, China, right? So also emerging markets are very attractive outside of India. India is the most expensive market. If you look at the dollar index or anything, we are definitely not, we are not cheap. So when you have rich valuations, you invite profit taking, right? So why would people not take profits when the market is high? When you bought something at a PE of 20, you were very worried, and now it is at a PE of 55. I think it's a great time to do some profit booking and shift your money elsewhere. We all will do it, right? We all will switch. I will not get out of equity, but I may get into more expensive equity, from a more expensive equity to a cheaper equity, to a less expensive equity. I would still be a buyer in certain things and a seller in certain things. I would look at the FII selling more as an opportunity than as a risk, because the pricing will improve. It is very useful for us to get shares at a lower price and have a longer waiting period. Having said that, market is definitely not cheap. It's nowhere in the cheap category. Whatever every fund manager will say, however we can see value in the market in these stocks, be careful. Be very, very careful. This is not a market which you are going to miss, saying, oh my God, I should have bought in October, November 2024. No, this is not a market which you are going to miss. It's not a runaway market, but yes, good deals are available. Thank you.